Good morning, everyone. I'd like to welcome you all back to our annual Financial Services Spring Briefing. Now, I think one word which would describe the Irish economy in the early part of 2025 is uncertainty. This is despite progress being made on interest rates, progress on inflation, near full employment, and increased growth forecasts for the Irish economy for this year. The uncertainty I'm talking about comes from what the CBI describes as the looming domestic and international threats. The governor recently said that domestically, we have a host of challenges in infrastructure, housing, transport, energy, and water, together with the risks that come with a very narrow tax base. Housing is making the headlines again, with housing completions in 2024 coming in at 30,000 units, as opposed to the expected number of 40,000. I think there was a sense of shock at this in government circles, which has prompted a review of rent caps and much discussion about reopening this market to international investment. Now, the Taoiseach this week emphasised that there must be private sector investment in this space and is in fact planning to use special powers to force the rezoning of land for housing closer to town centres. The new housing minister has said that up to now, the housing crisis has involved a lot of joined up thinking, but not enough joined up action. So he has created a new housing czar in the form of the Strategic Housing Activation Office. This office will be made up of both private sector and public sector staff. In his own words, they will be pragmatic and they'll go around the country kicking open doors where there are blockages to tackle the housing crisis. Internationally, we have more uncertainty and some might say volatility with the new administration in the US, particularly with regards to Ireland's over-reliance on its trade surplus with the States. We have the spectre of tariffs somehow being mixed up and interconnected with European security. The current offer on the table from the US appears to be commit funding and troops to convince Ukraine to accept the peace deal, or risk starting a trade war, which could be very damaging for European economies. Last night, Trump upped the ante by announcing 25% tariffs on the EU on cars and all other things. Not sure what he meant by that. More uncertainty. So there's a lot going on both economically and geopolitically. To help us unpack all these issues and to hopefully bring some certainty by way of hard data, I'm delighted to welcome back our keynote speaker, Seamus Coffey. Now, Seamus is one of Ireland's leading economists and is the chair of the Irish Fiscal Advisory Council. Before we hear from Seamus, though, for the first half of this morning's briefing, we're going to do something a little bit different from previous years. In a recent survey, when asked about growth drivers for Ireland's financial services sector, 92% of respondents highlighted technology and innovation as crucial catalysts for growth in the sector. So to try and lean into this for a financial services-based audience, we thought that it would be interesting to have a discussion on the digitalisation of financial services. Traditional financial institutions are undergoing major digital transformations to try and meet the needs of new customers who are seeking a more individualized experience. So instead of focusing on the pure legal elements of this, we've brought together our technology and financial regulation colleagues who are going to discuss certain key themes and to take us through the practical issues facing financial institutions today, particularly with regards to AI, cyber, big data, etc. Hosting this panel is the co-head of our financial regulation team, Liam Flynn. Liam will be joined by tech lawyers Oisin Tobin and Holly Pratt-Kelly and leading fintech lawyer Rowena Fitzgerald. Now, I will welcome all questions as we go through this morning's briefing, so please do feel free to use the Q&A tool at any time, and we'll try to answer as many of your questions as we can. There are poll questions that popped up on your screen a few minutes ago. Please try and answer them. They're available as we go throughout today's session. Answer them to try and so that we can get an idea of what your view is on some of the issues that we're going to be talking about this morning. For the moment, I'll hand you over to Liam.
Thanks very much, Neil. Morning, everybody. Really good to see so many people here this morning. So digitalisation, what a word, digitalisation of financial services. What are we talking about? The Financial Times ran a series of articles late last year called The New Titans of Wall Street. And these articles outlined how the big investment banks, the traditional names we all know and love, JP Morgan, Merrill Lynch, et cetera, have been sidelined in global securities trading over the last 20 years by privately held electronic trading firms. Now, these firms are huge. Citadel, for example, handles about a quarter of all US securities trades. They're also extremely technically sophisticated. XTX uses machine learning to scan and analyze trillions of data points for its FX trading business, and it's currently planning to invest €1 billion to build a 478-acre data center inside the Arctic Circle in northern Finland. So these are not financial institutions in the traditional sense of the word, as you and I have grown up and known them and loved them. These firms are staffed by mathematicians, engineers, software coders, not your traditional MBA types. They're very well paid. An intern in one of these firms can earn more than the chairman of the US Federal Reserve. The risks they generate for the financial system are not fully understood. We've seen flash crashes, flash rallies, exacerbated by their algorithmic trading patterns, and the regulators are constantly trying to play catch up. My point, I suppose, is digital transformation is constantly happening in the financial markets and has been for decades. What's new right now is that everyone, whether they're public sector or private sector, is talking about it. And on the surface, everybody's doing it. So the UK's Government Debt Management Office is talking about issuing gilts on the blockchain. Some major fintechs are selling targeted advertising space on their platforms, and they're looking at selling anonymized customer financial data. And even the BIS, the Bank for International Settlements in Basel, the super conservative banking provider to central banks, recently carried out a study using machine learning models to scan for suspicious payments. Hopefully they didn't find any. Everyone needs a digital strategy right now. But what's completely unclear is whether all this activity will lead to meaningful and productive transformation and lasting profitability. McKinsey at the start of 2024, surveying their CEO customers, identified priorities number 1 and 2 as generative AI, number 1, and leading in digital, number 2. Yet PwC surveyed 5,000 CEOs at the start of 2025 and found that the feedback was that they were making slow progress in digital transformation, held back in part by inertia and traditional leadership models and mindsets. So what are the factors that are holding firms back? In this panel, we're going to aim to unpack some of those obstacles, both internal and external, and hopefully leave you all feeling a bit better equipped to deal with the complexity of your own digital transformation projects. So without further ado, I'm going to move to the panel. My first question is to Holly. Holly, data. This is all about data, isn't it? Really, data is the lifeblood of finance now. So what are the big challenges that you're seeing clients struggling with in your practice when it comes to data management and data security?
Thanks, Liam. Agreed. Financial services companies really have evolved into being technology-driven companies in the last few years. And in particular, financial data, while not categorized as special category under EU data protection law, it's inherently sensitive and something that should be taken seriously by financial services firms. It's not news to anyone that financial institutions must comply with data privacy laws while complying with their own financial regulations that are applicable. And at the same time, it is challenging. As you say, digital transformation is not easy for any company, and in particular incumbents in the financial services sector, because of usually the way they're set up. Their data management, as you say, their data warehousing and their data security can sometimes be hard to ramp up in the way that's done by tech companies when they're nascent and new to the market. It's much easier for them to adapt potentially. They must store data in a way and process it in accordance with regulatory requirements, both under data protection law and the financial services regimes, which includes things like reporting, retention requirements. And while clients understandably want to use information in new and innovative ways, it does come with some drawbacks in terms of meeting the expectations of regulators in a data protection sphere. But specifically coming back to your question, the most difficult challenges that we see clients facing these days are probably threefold. Firstly, how to balance your security obligations while providing a seamless and frictionless experience for consumers and users on their services. This includes both providing services in a fast, convenient, and real-time way. In this context, technology can be used for things such as age and identity verification, and Oisín's going to be talking about biometrics verification in a second, as well as AML, which Rowena will touch on later, and sanctions checks. These can all be pain points, but technology can be used, but in the right way. A second point, challenging point for financial services is in particular in relation to data storage, what we sometimes call tech debt in the data team, because you're trying to use warehousing and legacy systems that may not be set up for the current demands of a digital transformation in the financial services sector. And this can be really difficult from a technical perspective to apply auto deletion and retention policies to those data warehousing and in terms of data mapping as well. And then thirdly, data minimization implications can be particularly challenging for financial services firms. This comes from the basis of general principles under data protection law, data minimization. You should only collect and use data that's absolutely necessary for your purposes, and the purpose limitation principle. You should only use personal data for the purpose or for a purpose that's straight, like connected to the purpose for which you originally collected the data. These can be difficult principles to get to grips with, because obviously once you have the data, you want to use it for whatever purposes suit your business best. But consumers in particular may be surprised if their personal data has been collected for the provision of financial services and then they're served ad tech, digital advertising or any sort of marketing based on that personal data that's been collected. So anonymization also is a very tricky threshold to meet in EU data protection law. So while you can technically anonymize personal data, it's not as easy to meet the expectations of regulators in this field. But I think Oisín might touch more on biometrics, which is a really interesting area.
Cool, thanks, Holly.
Thanks, Holly. Go ahead.
Cheers, thanks, Liam. And at the start there, you said there's this view that everybody needs some sort of cyber strategy or a data strategy. What I would say is, like, you need to make sure any strategy you develop is sort of based on your business and actually solving the specific pain points you have. I get a little frustrated when people say they need to do something with technology for the sake of doing it with technology. You want to not let the tail wag the dog, shall we say. But one of the big areas we've done a lot of work over the last 2 years in the digitalization space is around biometrics. And biometrics are really interesting for a bunch of reasons. I mean, on the one hand, they're quite risky legally to do from a privacy perspective. It's been announced by the Data Protection Commission that Ryanair is under investigation for their use of biometrics for customer verification. So, if you get this wrong, there is a risk that a regulator will at least take an interest in what you have done. But that said, biometrics they can be quite attractive from a business perspective, particularly for regulated FS companies, because one, it can reduce customer friction for onboarding, which is great. It allows you to compete more effectively. And they can also reduce your risk on the regulatory side as well when it comes to things like know your customer, remote customer verification, etc. So there can actually be a risk reason to sort of adopt a biometric approach. That said, biometrics are special category data under the GDPR, translating that from tech law tech nerd-ese into English. That means that it's kind of hard to handle biometric data. And to really simplify it, you pretty much either one need to get consent from the data subject, and that's GDPR consent with all the bells and whistles that entails to create a biometric on someone's face, or alternatively, you have to take the view that your processing of the biometric data is required by law. So there's kind of two different paths you can go down here, and I've seen companies go down both. Usually, if any company is ever considering saying they're required by law to do biometrics, it's an unusual enough approach. It has been done. I've seen it done more frequently by companies based in London. But if you were to take the position that your regulators and your legal framework requires that you do biometric verification, then that does provide you with a path forward, albeit one that has various potholes I won't go into in this call. But the other way you can do it, which we have seen a number of companies use successfully, is to say that, well, we're not going to force people to do biometric verification, but we actually think it's a fairly good way of approaching things. So we're going to give people the option of verifying their identity by way of biometrics. And as I said, we've worked with a few companies on this. What I can tell you is it is doable. The Data Protection Commission will look very, very closely at what you're doing. The sort of things they will look at will be the design of the relevant flow that you present to the end user in the app. They'll want to make sure that people are given a truly neutral choice to either use biometrics or not. No design tricks. I often tell clients, no funny business. It has to be a true choice. You also have to not penalize someone for declining to use the biometric version. You have to look at things like, how long you keep the face mapping for, and that in turn can go back to your KYC requirements as well. And crucially, you're also going to have to be able to justify to the Data Protection Commissioner, why are you actually doing this? What is the benefit? Holly mentioned the whole idea of data minimization. That's crucial with all this. And, you don't want to do something because your engineers think it's cool. That is not a justification you can put to a regulator. And believe me, I've tried, it doesn't work. So you need a really good, strong reason to say, look, we want to do biometrics to achieve these specific business aims. And if you have a really good business plan, good technical implementation, and crucially, if you get your documentation right, things like your data protection impact assessment, and you have a good narrative, you can actually launch these products. And if you need to engage with your regulator, you can and go through the process, but it is doable. So all of this is to say that while there can be a lot of challenges with some of the digitization deployment of new innovative technologies in a heavily regulated space, there tends to be a path forward. It just sometimes requires a bit of legwork.
That's great. So the clear message is, figure out what it is that you really want to do and why you want to do it before you get started, because there's a lot of potential pitfalls and you're going to fall in them if you haven't figured out what you're trying to do in advance. Yeah. Okay, great. Rowena, from the financial services regulatory perspective, are these issues generally left to the DPC and the data protection authorities, or do the FS regulators get stuck into these sorts of issues as well?
Yeah, thanks, Liam. And good morning. Good morning, everyone. I think, look, for regulated financial services providers, they're in the unfortunate position of having to take the views of a number of regulators into account and a number of different regulatory frameworks as well. Saying that, we don't often see direct conflicts between, say, a position that the DPC might take on a particular issue versus a position that the Central Bank of Ireland might take. And while the DPC is obviously the primary regulator for all things data related, the Central Bank does have a wider ambit in terms of, say, customer and consumer protection more generally, and they are very much concerned with how a customer's various rights are safeguarded, including those relating to data. Reference to data and how it's used and accessed is actually something that's crept into newer financial services regulatory frameworks over more recent years. For example, PSD2 explicitly refers to how data should be managed with explicit provisions governing the use of sensitive payment data. And you also have new regimes such as the crypto assets regime under MiCAR, which expressly calls out GDPR obligations. However, look, like Holly mentioned, an example where there can be some regulatory friction for financial institutions is where it comes to compliance with anti-money laundering obligations. And as Oisin's also mentioned, we're finding that more and more firms are seeking to use biometric data as part of their client ID verification tools. But I think firms have to get the balance right between, say, the use of technological innovations to meet their AML obligations, and then also having a legitimate reason for obtaining that information and storing it and using it from a GDPR perspective. And Oisin and I have many examples where we've worked together to figure out those parameters for clients that are financial institutions. I think just to note as well, and one thing that comes up now and then is where a financial institution looks to request a customer's PPSN number. That's also an area of contention, and the DPC has been very clear that a PPSN should only be requested by banks and credit unions who actually require that information under law to report dirt. So that's the tax, not gossip, to the revenue commissioners. I think one important point to note as well for regulated financial service providers relates to reporting. I think back to your point, Liam, about regulators and their approach, I think is that if you are a financial institution, a regulated financial institution, you have a data breach, say, and you feel that that's reportable to the DPC, don't assume that that's enough. Regulated financial services providers should also be considering whether they need to report the breach to the central bank as well. What you wouldn't want to happen is there for to be a significant data breach and for that to be reported in the papers, and then for the central bank to come knocking on your door, asking why haven't they been notified. So I think it's important to make sure that in addition to assessing any data protection or DPC reporting obligations you might have, that a parallel reporting to the central bank is also considered. It may not be required, but it should be considered. So in short, while different regulators will have their own positions on things, I think for the most part, we'd expect those to be aligned.
Great. Yeah, thanks, Rowena. Okay, so quite a bit of regulatory complexity in this space, as we're discovering as we go through the call. Holly, going back to the top of the call, I mentioned that CEOs had identified from McKinsey at the start of 2024 generative AI as their #1 priority. There's huge interest in the financial industry in the use of AI, but what are you seeing on the technology side generally?
Yeah, thanks, Liam. Well, firstly, AI is such a vague term and it's so broadly understood. So things that financial institutions have been doing for years, such as analytics or financial risk or asset modeling, they all fall under AI. But the new shiny version of AI that's now in front of us every day is things like generative AI and LLMs, large language models like ChatGPT. And we obviously saw the newcomer to the market, DeepSeek, in the recent weeks. So we are seeing from financial institutions that they're definitely trying to get to grips with the new versions of AI that they could use to try and streamline or make their business more efficient. What Oisin referenced earlier in terms of doing something with technology for the sake of it, that is also a big risk when it comes to AI. You think that you can apply it to anything to make your life easier, but actually the ways in which financial institutions are going to use things like generative AI and LLMs is unknown at this time. There's certainly pilot programs being undertaken by them. From a generative AI and LLM perspective, we would usually see it in the customer support sphere and in chatbots on a platform to allow quick questions. What's something that we've seen certainly a lot before, and Oisin has worked on this so much, is how to protect against hallucinations by the AI system. That to ensure accuracy of the data and the responses that are provided, and also to ensure that the AI system is not tricked and that they hand out user data to a bad actor, is something that's really important to keep in mind. And I think that Oisin will be talking about in a little bit. So everyone wants to be able to say that they use AI in a variety of different systems. What we've also seen is a tension between the legal teams within financial institutions and the marketing teams in terms of the use of the phrase AI, because you want to be able to describe your products as using AI to show that you're using the cutting edge technology and what's on the market and you're ahead of the curve, but also that attracts regulatory scrutiny. And we've had instances in which the Data Protection Commission has requested a fulsome list, an exhaustive list of every AI system that's used by our clients. And that's almost impossible to actually do because it does encompass such a broad range of things, any sort of analytics and metrics that you conduct. So we've definitely seen that AI is on the up in terms of financial institutions and their testing of it and their pilot programs, but it's unknown at this stage where it will go in terms of the newer versions of AI. What we do know is that it's here to stay in terms of financial risk, financial modeling, and pattern detection of fraud. Those are the things that it's definitely being used for and will continue to be used for because it adapts well to that use case. I don't know if Oisin, you now are talking about the rest of the AI.
Yeah, I can definitely jump in on that. I mean, obviously, I'd echo everything Holly just said. I'm still not entirely sure what anyone means by AI in any given context, and I've been working on this stuff probably in excess of 10 hours a day every working day for the last year and a half. So this is an area where there's a bit of a weasel word around AI. Nobody outside of very specific statutory definitions of the likes of the AI Act, which it focuses on the AI being an autonomous system. You kind of want to pin someone down if they're talking about AI and ask, what do you actually mean? And this sort of goes back to kind of the whole idea of making sure, you figure out what your strategy is and then leverage the tools to deal with them. you know, AI is not a monolithic category. It covers a variety of kind of different types of technology, some of which, like credit scoring, has been around for years and years and years and years. So how do you manage the AI risk? Like what are regulators actually looking at here? I mean, I would say there's kind of two big bodies of law that are particularly relevant, which are the GDPR and the AI Act. The GDPR deals with any processing of personal data, training a model, running data into a model. That's all caught by the GDPR. And there's a lot of unknowns and a lot of uncertainty at the moment around how GDPR actually applies and how it regulates models, particularly generative AI models. There was guidance issued by the European Data Protection Board just before Christmas, which we hoped would give us a bit more clarity here. It tended to raise more questions than it answered, I think is probably the best way to put it. And what we can clearly see, though, from kind of both that guidance and also kind of constant interactions with the regulators, is that there is sort of an acceptance that AI is a thing, it's not going anywhere. There's also this kind of broader understanding that Europe cannot really let its laws, suppress this new technology. I mean, particularly with big influence of the Draghi report here and looking at what's going on in the US and China, there's kind of an understanding that European companies will have to use AI to compete. That said, when it comes to data protection issues, what you do see is a fairly robust application of the basic principles of data protection law around AI. So what I tend to see a lot is that there's a really big focus on data minimization and justifying how you've built the model, why you've built the model, and what data you've used to train the model. And there's an inherent tension here because one of the big one of the starting points of the truisms in AI is just feed more and more data into the model, have to make the training corpus as big as possible. That makes the model better. That is not like a very rough rule of thumb. But that obviously causes legal issues because, from a lawyer's perspective, it would be better if the thing was targeted, more focused, and you could justify every piece of data you fed into the training process. So, that's one thing you want to look at as to how exactly are you building this thing. The other big area of focus is the compliance documentation, and this comes through constantly in both regulatory publications and also the engagements we've had. And there's a real focus, particularly from the DPC, in making sure that if you're doing anything with AI, you've really high quality data protection impact assessments in place. And, you have carefully documented, how you have thought about various risks and factors and how you've dealt with them. In fact, one of the only formal inquiries opened by the DPC at the moment into AI is into Google over alleged deficiencies in their data protection impact assessments. So what you tend to see is regulators aren't opposed to AI in principle, but they really require that you show that you have thought this through very, very well. The other big law when it comes to AI that's relevant is the AI Act. Not yet, leaving aside the prohibited AI provisions, generally most of this is not yet in force. One of the key points to note for the attendees on this call is that credit scoring and the use of AI to price life and health insurance is seen as a high risk deployment of AI. That means there's extensive obligations under the AI Act, including the likes of conformity assessments that have to be done. So I guess what I want to flag that point because you could simply be optimizing existing processes with functionality that could fall within the definition of AI, and you could be caught by the AI Act, even if you aren't using any of the bang whiz generative AI purposes or technologies. So, I guess in terms of market practice, this is an area where we see people, people might actually be using AI without realizing it. But there is sort of a slow process, I think, in terms of using the fancier functionality like Jet AI, largely because its application in a financial services context is, to my mind at least, a little unclear.
Very good. I might jump in there actually and throw one at you, Liam. I know you've been doing a lot of work in this space for, say, regulated financial services providers. What would you say those firms need to bear in mind when trialing AI and using it, say, over and above what other unregulated firms would need to do?
Yeah, thanks. I mean, like Oisín just said, the AI Act itself says very little that's specific to financial services. So its principles apply generally, for the most part, to the finance sector as they do to other sectors. It does call out those two high-risk applications where, like Oisín said, there are extensive parameters around the way that high-risk applications potentially need to be governed and need to be tested and so on and so forth. But I suppose the interesting part is that the financial regulators are still grappling a bit with whether, in addition to the regime under the AI Act, and associated guidance that no doubt will pour out from the European institutions, once the Act is fully in effect, whether special guidance, sectoral guidance for the finance sector is needed. And it first looked very much as if the European supervisory authorities were going to go heavily down this road, because there were a number of consultation documents and experts' reports and so on and so forth that were issued by the ESAs, by EBA, EIOPA and ESMA back in 2020, 2021. Now, there were strong representations from the finance industry and from representative bodies like the American Chamber that really this was the wrong approach, and that the finance sector didn't need to have sector-specific guidance that they had been using, and Holly referred to this earlier. They've been using AI in that very broad, general, inclusive sense, the machine learning, traditional forms of AI for decades. And they've been managing it within their normal risk management parameters and within their normal ICT risk management frameworks and operational resilience frameworks. And they don't need any special sector guidance, thank you very much. And that looks as if it may have been at least partly successful at the Commission level, because the Commission consulted last year on whether or not special sector guidance was required, and so far nothing has been produced. But the ESAs can't quite leave it alone. So EIOPA, which is the sectoral regulator for insurers and pension funds, issued a draft opinion for consultation a couple of weeks ago on the use of AI by insurers and pension funds, in which they lay down internal governance, management, and special record keeping practices for firms that are intending to use AI in that sector. ESMA produced a guidance statement for investment firms using customer-facing AI back in July 2024. The EBA is the only ESA that has not published sector-specific guidance as yet, but the EBA has been monitoring and has been conducting thematic reviews on the use of AI by banks, and they have specific pages on their website which are focused on AI and the use cases and so on. So I think it's only a matter of time before they go down that road as well. And Irish firms are going to have their own layer of regulatory oversight when the specific requirements relating to customer-facing digitalisation projects in the revised CBI Consumer Protection Code are finalised later this year. So I suppose in answer to your question, Rowena, long answer to your short question, what do they need to do? They need to do what they always need to do, which is, look first at the specific digital law and privacy law questions that Oisín and Holly have been talking about, and negotiate all the obstacles they need to negotiate in that sector, but while at the same time making sure that they're aware of and are complying with the expectations of the financial services regulators, which for the most part tend to run in parallel channels, and we don't often see conflicts between them. But they nevertheless have to be separately monitored, they have to be separately tracked, they require audit trails that can be produced to each of the respective regulators to demonstrate that the expectations have been met. And I suppose in my mind, there's a question to be asked as to whether on the FS regulator side, all this regulatory activity is adding value, given that the industry seems to be struggling a bit to identify meaningful customer-facing use cases for generative AI. The EBA back at the end of 2024 said most banks are only at testing or pilot stage, and most of the use cases are chatbots and inward-facing applications. So the EU regulators have definitely tried to get out ahead of an anticipated wave of AI activity in finance. But let's hope they haven't jumped the gun, and put a layer of regulations in place for something that may not materialize into a big area of activity. So moving on into, I guess, the general area of big data, and we're talking a lot about data on this call, as Holly said. Data is very much the lifeblood of financial services firms, and they've really morphed. They're starting to morph into virtual technology firms at this stage. So we're going to move on to open finance. The EU is proposing to introduce and has published a draft proposal for a directive on open finance, which would essentially enable customers to allow freer access to their financial data to operators across the sector. Rowena, I'm gonna ask you, how would those proposals, can you just outline to us, explain to us on the call, basically what would those proposals do, and how would they fit in with the existing frameworks that we know and love in the payments sector, PSD2, and obviously that's all under review, and we could have PSD3 and no doubt 4 and 5 and 6 at some point. So yeah, outline all of that for us if you wouldn't mind.
Yeah, no problem. I think maybe at the outset, I'll just take a moment to explain what open finance actually is, because it's one of those terms that's often thrown out and used without explanation. So in general terms, open finance refers to the sharing, access, reuse of personal and non-personal data for the purposes of providing a wide range of financial services, with the overall aim being to promote innovative financial products and services that benefit both consumers and say that the financial services firms themselves. We already have a concept of open banking, which is regulated across the EU by the Second Payment Services Directive. And in short, open banking allows payment service providers such as, say, banks and payments firms to share your financial data with certain authorized financial services providers with your permission. An example of that might be where you connect your bank account to, say, a budgeting app that analyzes your spending. You give the budgeting app the permission to dip into your account and to pull information from it. And the budgeting app and your bank speak to each other via an API, and effectively an API allows the bank and the budgeting app to speak to each other, so their systems can talk to each other and share data. The existing PSD2 regime, so the open banking regime, it's expected to be further strengthened by the payment services, the Third Payment Services Directive, like you mentioned, Liam, alongside a new regulation. And overall, it's going to aim to increase the competitiveness within open banking by strengthening the rules around APIs. It's going to set benchmarks about improving APIs performance, and its aim is to remove some of the existing obstacles to third-party providers being able to access customer bank accounts. And then separate open banking initiatives under PSD2, PSD3, we now have proposals for the open finance package. And effectively, that'll expand the scope of services. So the services to be provided by other types of payment or other types of financial institutions beyond just payment accounts. It'll be expanded to other areas of regulation, such as, say, insurance, loans, investments, pensions. And under the new open finance framework, it's proposed that there be a licensing requirement for third parties seeking to provide information services, like there currently is under PSD2 and the open banking framework. And effectively, financial services providers will be required to open up their systems to allow their customers have their data shared with third parties. So in short, in a few years, we'll have the existing open banking framework under PSD2, PSD3 for payment services providers. And alongside that, we should have a separate regime for insurers, investment firms, lenders, pensions providers. I think what I would say is that it's still early days in terms of open finance, but I think it's a sign of where policyholders see things going. And I think ultimately that's giving customers control over their own data.
Great, thanks very much. Holly, anything you'd like to add to that from the, I mean, this sounds like a data lawyer's dream, frankly, all this data flowing about. What would you add to that from the data side?
Well, from the data side, I don't want to sound like this wouldn't be something that could definitely be manageable from a data protection perspective. And there could be implications for this Data Act that no one's talking about, but it's certainly to be important. It doesn't deal with personal data, it deals with like other types of data, like technical data. And I think I would just reiterate things that Oisín mentioned earlier, that you have to make sure that you have data protection impact assessments and appropriate accountability documentation in place. Internal governance will be really important in terms of their data governance. Where is the data going? Because the more sharing of data there is between different service providers in the industry, the more data mapping and accountability that needs to be done to make sure you know where your data is going, where you're getting it from. And that feeds into things like data minimization, storage limitation, applying deletion to that data. And a final thing I would think about that we haven't discussed here is just making sure, or something that Oisín mentioned earlier, but making sure that you're not nudging users to basically sign up to open finance. There's a concept called dark patterns. You're trying to make it as neutral as possible in terms of the optionality of whether to opt in to have your data shared or not. That's something to keep in mind. And then the key takeaway is that if you're going to try and do something on the basis of a legal obligation, as Oisin mentioned earlier, it should be as specific as possible in the law, or else it'll be much more difficult to say that you're under a legal obligation as your legal basis to actually do the data sharing and the data transfers in place. So vagueness is not your friend. You want it to be as specific as possible. And you also will just have to navigate the new regime when it comes into force, and talk to data protection advisors at the same time as considering your financial services requirements. That's how
Good advice. Go nowhere without your data privacy lawyer beside you. Thank you all very much. We're going to hand it back. That was really great. I must say it's given us a really good overview of the kinds of issues that clients are struggling with in the digital transformation area every day. And so much of it is about planning and about careful thought and careful project management and project execution, because there are lots of pitfalls on the road. Neil, I'm going to hand back to you now. I'm going to say thank you to Oisin, thanks Holly, thanks Rowena, and back to you, Neil, for the rest of the presentation.
Thanks very much, Guy. That's really interesting. An unbelievable amount of ground covered there, and some really good recommendations for everybody. Now, as I mentioned at the start of the briefing, our keynote speaker is Seamus Coffey, the former and the current chair of the Irish Fiscal Advisory Council. 500 odd people didn't log in, Seamus, to hear me. So you're very welcome. Over to you.
Thanks very much, Neil, and thanks for the invitation to speak to this. So I'm just going to share the screen and go through a couple of images to try and highlight what it is we're going to work through for the next maybe half an hour or so, and then we'll have a bit of a discussion and a Q&A on certain issues. So I'm going to go through a couple of issues for the next while, just looking at where we are, maybe what issues are arising, not necessarily to go through the risks, but maybe to look at some of the underlying elements that might then maybe get us to a discussion of the risks as they arise. So we'll try and pick 4 topics that are relevant for where we are now, and maybe if we have sufficient time over the half an hour to work our way through them and see where it is we're going and what we are. We'll look at maybe home ownership, we'll look at housing and links to that. One issue that maybe isn't getting sufficient attention in recent times has just been the nature of the change in employment in Ireland in recent years. And if you're going to do something on Ireland, corporation tax, so hopefully we'll conclude with a bit of that. So just to look at where we are and where we find ourselves as an economy, this is just a picture that really you could use to describe the last 25 years of the Irish economy, just looking at sort of savings and borrowings of the 2 key sectors of the economy in terms of the final outcome, that being the government sector shown and the household sector shown in blue. And in the middle, we have 0. And if a sector is above that, it suggests it's running a surplus. It has more income coming in than spending. And if the outcome is negative, if we're below the 0, that suggests a deficit, that the sector is borrowing and spending more than it's earning. And here we have it for the last 25 years of the Irish economy. And just the swings from one very deep negative up to 2008 to where we find ourselves now is extraordinary, and there's maybe a bit of a symmetry to it. You can see there for around 2007, 2008, it was a deficit of minus 16 billion, up to the crash driven by the household sector, the huge increase in credit that was driven by the banks. And now we find ourselves in a position where we're plus 16 billion. So it really has been an extraordinary turnaround for us in recent years. Just looking at where we find ourselves. Yeah, so this is where we find ourselves in terms of just the position of the economy. Are we living within our means, to go back to the phrase maybe from a Taoiseach back in the day? And we can see now, if we look at both sectors, they're both very strongly positive, that we are running surpluses. The household sector has more money coming in than it's spending, and also the government sector has more money coming in than it's spending. So what we'll do over the next while is maybe look at sort of explanations for why that is the case. Are we on a solid footing? We look at the household sector and maybe what they might be doing with some of that funds, and look at the government sector and see like how those funds are being generated. Caroline, we can move on. So we'll just look at the household sector, and like really we have a picture here that shows an extraordinary change over, like, this is a relatively short period of time. We're just looking at 2003 up to the end of 2024, and again from the last slide, just this change in behavior we've seen in a very, very short period of time. So the red line here represents the total amount borrowed by households from the Irish banks, and the blue line is what they've put on deposit. And we can see during the boom periods up to 2008, that credit bubble, that huge increase in borrowing from just 60 billion in 2003 to, by the time you get to 2009, total borrowings of the household sector from the Irish banks of 180 billion, a trebling in just 6 years. Like, when we look back at it, it really was an incredible period of credit expansion. But then the deleveraging we've seen over the last 15 years is equally incredible. Like, if you looked at 2009 and said by the time you roll forward into the early 2020s, that Irish households would have tens of billions more on deposit compared to their loans, like, you really would have been laughed out of it. But that's what we see happening. We've seen huge deleveraging. In the main, those loans have come down in the last 15 years, but repayments, yes, there has been some delinquency and some loans not repaid, but the bulk of it has been achieved with repayments. What's notable, though, in recent years is just this rise in deposits. And you can see that blue line, just in the last 5 or 6 years, even pre-COVID, it was beginning to edge up. And this is maybe an unusual issue for us in the sense of having significant sums that seem to be set aside. And what this can tell us about the household sector, and maybe just look at some of the distribution of it. So if we just move on, we can look at the average per household. Now, we will note that averages can be misleading, so we will look at this in a bit more detail. But if you just look at the average amount of deposits per household, so they're close on 1.8, 1.9 million households across the country from about 2013 on, which is where this data from the ECB starts. It really wasn't changing a whole lot. Deposits were growing, but so too were the number of households. So the average was staying around 70,000. But we can see what's happened in the last number of years. And that average has risen and risen very rapidly in a very short period of time. And is now heading for close to 100,000. So this is a very significant sum. We will look at the breakdown in a bit detail. It's not that every household has 100,000 on deposit, but just like an overall indication of the increase we've seen in recent years. It is quite significant. So now we can start to look at the breakdown. So we move on to the next one. We can look at sort of a breakdown by employment status. Now, we don't have optimum breakdown on this. Like, if I was to look for the key breakdown, it would be by age. But we can look at different categories and again look at the spread between them. And perhaps it's not a surprise to see the self-employed coming out there at the top, maybe the more precarious and sort of a risky position self-employed might find themselves in terms of income and having money set aside for contingency. But it has increased very significantly in recent years. And now, on average, a household headed by a self-employed person has around 150,000 euro on deposit, compared to about 100,000 maybe 10 or so years ago. Coming second then are the retirees, which were trending down up to around 2018, perhaps as people were using up their savings in retirement, but in recent years has gone back up and exceeds 120,000. The middle category, we can't really tell a whole lot about it. And then we have the employees, which probably find themselves in the main on a more stable footing in terms of the monthly check arriving in. But have also increased their deposits from maybe 50 up to 80,000 in relative terms is actually one of the largest increases. And then for the unemployed, it hasn't changed a whole lot. And you can imagine that perhaps being driven by people perhaps that are short-term unemployed, maybe moving between employments or have different elements rather than being broadly spread across the unemployment sector. But just think in terms of trying to get a handle on where this money is and who has it. And we can kind of see that it's broadly spread across all categories of work. Again, if I was to look for a breakdown that provided the best information, it would probably be by age, but we don't have that from the ECB. But what we do have is the next one, which perhaps leans a bit closer to that breakdown by age. If we can just move forward. This is just the distribution. It's not by age. And again, highlighting maybe that initial figure of averages do need a bit of delving into. And if we look at it by sort of deciles, the top 10% through the next 10%, and then the bottom group is the bottom 50%, we can begin to see perhaps the unequal or uneven distribution of those deposits, maybe just the scale of them that are held by some households. So that blue line there way out on the top, that is the top 10%. And we can see that they have increased their deposits to a reasonable extent, not in relative terms, not the largest increase, but going from maybe just under 350,000 to close to 400,000. So 10% of households, if we have 1.8 million, is about 180,000 households in the top 10%. So it is a pretty significant number. And they have on average close to 400,000 on deposit. Now you could delve into this and see what share of their overall net wealth was it, but it is a pretty significant amount. And then you can go through the next 10%, the third highest 10%, the fourth highest, the fifth highest, and right down to the bottom 50%, which will just accumulate together with the green line at the bottom. But still, you're getting a total, an average down there of around 30,000. But the chart, I suppose, does highlight the divergence there is in these deposits. So it's not spread across everybody. We can look at it by employment status as we have. We can do it by deciles of net wealth, and we can see that a large share of it is held up towards the top. So we can move on again. Now we're beginning maybe to get some indication of the breakdown by age, but this isn't perfect. But I suppose a key difference between owners, the orange line, and renters, the blue line, would tend to be age. Now we would even look for, if possible, greater breakdowns here. You could break owners into those with mortgages and those without. You could break tenants into those renting privately and those that are social housing tenants. But those breakdowns aren't provided. But I think here we can show that there is maybe a leaning more towards the older age categories, just given the nature of the increase we see for both the orange and the blue line. This is probably as good as we get. So I think we have this indication that these huge tens of billions that have been built up on deposit in recent years. Some of it was because the economy shut down during COVID and we couldn't go out and spend our money. But it had even started pre-COVID and has continued since COVID restrictions were lifted. So it does look like we've had a greater tendency to place money on deposit in recent years. And maybe the use of that and why we have that is something that is worthy of delving into in a bit more detail. And then if we just move on, just looking at sort of, you just want an indication of what's happening to wealth inequality. We maybe hinted at it with the breakdown by the deciles there previously, but just looking at wealth inequality in Ireland, and here we have wealth shares, like how much of the overall wealth is held by different parts of the distribution. And the blue line there is the top 10%, and wealth tends to be much more unequally distributed compared to income. And looking at the distribution of wealth, we can see the top 10% held about 60% of overall net wealth in 2013, just over a decade ago, and is now down to around 50% now. So the share held by the top has declined, and that has been picked up mainly at the bottom, with the bottom share going from close to zero, and we're dealing here with the bottom 50%, so half the population in 2013, up to around 10% now. So this suggests that wealth inequality in Ireland has fallen in recent years. Now, I wouldn't necessarily think this is because of a greater democratization of assets. We still see that those deposits we looked at were very, very unequally distributed. I think we know that this in the main has been driven by rising house prices, and we'll come to look at the distribution of housing in due course. But back in 2013, there still would have been a share of households with negative equity. So they would have been towards the bottom of the wealth distribution, who would have had perhaps a mortgage that exceeded the value of their home. Over the decade since, as we said, there's been loan repayments, but also very significant rises in house prices. And that has pushed those back into positive equity and into positive wealth amounts. So that reduction in wealth inequality is very much a story of house prices, not necessarily a wider spread of the assets. But it does show that wealth inequality is a bit lower now than it might have been maybe 10 years. And Ireland would be a bit unusual in that regard, with wealth inequality deteriorating in most countries. So now that we sort of introduced housing, maybe through the tenancy and the impact it's had on the distribution of wealth, if we start to look at housing in a bit more detail, we can move on to the next one. which just shows us the first-time buyers, so those that are actually getting on to the housing ladder, and the number of first-time buyers. This is numbers from the CSO going back to the start of their series in 2011. So this is on an annual basis. How many people, how many first-time buyers are purchasing a property? This isn't the total number of first-time owners. You'll have people who build their own house, self-builds, you have perhaps people who get houses through bequests, and maybe you'll have non-market transactions where people might acquire property. This is looking at your standard first-time buyer going and purchasing a property on the market, making the payment, and continuing from there. And we can see that the blue line, the total number of first-time buyer transactions, has been around 17,500 per year for the past 12 months or so. And has been pretty stable there for the past while. So you're probably talking around 350 to 400 first-time buyer transactions a week. Now, this is not to say this is the right amount, but it certainly is a number, 350 to 400 a week. So people are getting out there and are purchasing housing. Maybe one thing that's interesting in recent months is just the split between existing dwellings and new dwellings, and maybe some of the narrative about what's happening to housing construction, housing output, and where the housing is going. Actually, what we've seen in recent months has been a decline in purchases of first-time buyers of existing dwellings. So we have a housing stock of about 2 million. At any given time, a certain share are up for purchase, and first-time buyers can buy those. And they're buying in or around 12,500, maybe declining a bit now, of existing dwellings. Given the sort of narrative on housing completions, etc., it's perhaps surprising to see now it's not a huge increase, but for new dwellings, we see a gentle rise in the number of new dwellings being purchased by first-time buyers. And I think as we get into it, we can perhaps see this being a change in the composition of what we're building, and perhaps not necessarily for the better. So we do have first-time buyers, and with that, then we can begin to look at home ownership and the impact that might be having, and where does that sort of the popular position on the home ownership sit. So if we just move on, we just have a holding slide and then move on to the next one. Just looking at home ownership in Ireland, and here we have as long a series as we can do from census data, sort of the best, most comprehensive sort of source of many bits of data that the CSO provide, where they try to look at all households and collect data. Now, the primary purpose of the census is a head count, and that can have an impact. But since 1946, we have been collecting data on tenure status. Now, not in every census. It was actually done only sporadically in early censuses, but it has become much more frequent since 2002 on. So we have a reasonable series, and we can look at it. We can see it peaks there around 1991 and has been declining since. And this is the headline home ownership rate. And you would get maybe various suggestions about what's happening to home ownership in Ireland based on this rate here, and perhaps people pointing to the decline between census 2016 and census 2022. But we can actually look at this in a bit more detail to see, well, maybe there's underlying trends here that kind of explain some of this, and maybe the decline isn't as severe as perhaps the headline rate would suggest, going from 79% in 1991 to about 66% now, and declining from each census on. So if we go to the next one, we can just add one element that kind of has a role to play, and that is that when we do the headline rate, we take all households in the census, but actually in some cases all we really have is an idea that the household is there. Maybe they don't fill in all the questions. And in many cases, some of these go not stated. And in fact, if you look at the gap between our two lines here at the moment, we can see that gap widening. And that's the gap between all households in the census and those for which their tenure status isn't stated. And in the last census, about 80,000 households where tenure status wasn't stated. And that's over 4% of the total. So really, if you do a sum and look to add it to 100%, what actually you'd find is you get a share of home ownership, a share of renting, and then you'll have this big 4% share of not stated. One reason for this is that the CSO have been trying to make the census a more accurate count of the population. So in some cases, they actually do what they call reconciliation forms. They know there's a household there. They maybe have a good indication of how many people. So there is a partial form submitted by the enumerator, for that household without knowing the full details, without knowing the ages of them, their occupations, and also without knowing their tenure status. And they've been doing this more and more and more in recent censuses, again, to try and make it a more accurate head count, which of course is the primary purpose of the census, but then maybe we lose some of the detail when it comes to these other indicators. So one issue with the home ownership rate is that perhaps we should strip out these not stated. We don't know anything about them. The CSO are putting them in because they want to count the people, but it's not helping us get an indication of what's happening to home ownership. So that blue line there is all censuses since about 1999 or sorry, 1991 on, excluding the not stated. And actually you can see, yes, there's still a decline in home ownership, but because the CSO have been using more and more of these reconciliation forms, actually we don't see much of a decline in the last 10 years or so. If you look at 2011 to 2021, it's actually relatively flat. So this decline that gets a lot of airtime isn't necessarily showing true. If you just strip out those households, well, whom we know nothing about their tenure status. And of course, the composition of the Irish population has been changing. So if we move on, we can look at, for the next slide, we can look at, sorry, this is households headed by an Irish national, which just reflects this change in the population. And if you look at the Irish population now, compared to where it was in 1991, in 1991, pretty much everybody was an Irish or UK national. Now we've about a sixth or a seventh of the population who were born outside the UK or Ireland. And these tend to be people who've moved here, maybe people who've moved for employment, people who've moved on maybe a reasonably short-term basis. It could be 5-7 years, but not necessarily to purchase a home. So if you look at those that have moved to Ireland to work, they will primarily be in the private rental sector. And if you look at Irish households headed by Irish UK nationals, actually the home ownership rate is a touch higher. Now, not significantly higher, but it is undoubtedly a touch higher. That we have a changing population. And if you put in more people who are more likely to be renting, well, that would push down the home ownership rate. And they may not possibly want to be in a position to purchase a home. They may think that they'll be here for a number of years but before moving on again, just as Irish people do when they move to Australia, etc., for a number of years. They're unlikely maybe to be home owners over there, but perhaps like to come back and be a homeowner here. And if we now compare the position to 1991, if we can just move on to the next one. Now, as I said, we don't have a breakdown of nationality. It wasn't an important issue in previous census. Like I'd say 99% or thereabouts of the Irish population in 1991 would have been born in the UK or Ireland. It's a different position now. We can actually suggest that maybe for Irish and UK nationals, that home ownership might have peaked in 2006, not necessarily 1991, or at least some period between it, because 2006 is higher than 1991 and then declined. But most of that decline happened up to 2011, has been relatively flat since. So to actually make a comparison, if we just move on, we can add a comparison of home ownership rates that might point to a sort of where we actually really are. Like if we take account of the not stated forms used by the CSO and the changing nature of the Irish population. In 1991, we're looking at a home ownership rate across all households of 80%. We can take it that 99% of those households would have been Irish UK households. And we look forward to what the last census told us for households headed by an Irish or UK national. We get a home ownership rate of 75%. So a decline, but maybe not as significant as the headline rate might suggest. Now, this is not to say that everything is rosy when it comes to our housing situation, but I think the home ownership rate might not necessarily be the best way of sort of assessing and looking at that. In fact, if we had better housing outcomes, it's possibly likely that our home ownership rate should be lower. And why now might we say that? So if we move on to the next slide and just look at sort of a population change and look at different types of population, who is living in households, particularly who's living in households outside the family home. So here we have the last three census counts of population from the CSO, and we start with sort of the top half here, looking at the population going from 4.6 million in 2011 to just over 5.1 million in 2022. So a pretty significant change over a 10-11 year period of over 10%. If we look at the population aged 20 to 34, and then try to link that then to households as we do in the second part. So the population aged 20 to 34 was just over 1 million in 2011 and around 935,000 in 2022. Now, this isn't a fall or people leaving the country. This is just demographics. We had a baby boom back in the early 80s.
And those people are going through the system now. In fact, if you look at this age cohort and look at the population aged, what it would be 31 to 45 in 2022, they're up about 10%. So they've benefited from inward migration. But just focusing on what we call younger people at a point in time in life, we have them making up in 2022 about 18% of the population. But if you look at the total number of households, like here's where we see the loss of households, people that can't move out of the family home, that can't move into their own accommodation. And in the main, younger people will leave the family home to move into private rental accommodation. If you look at 2011, people aged 20 to 34 were around 23% of the population, and people under 35 headed 22% of households. So they had much the same spread, whether you looked at it by population, by head count, or by households, who was filling out census forms. They were 23% of the population and 22% of households. Roll forward to 2022. Those people aged 20 to 34 are now 18% of the population. And again, that's just demographics, that baby boom from the 80s moving through. They made it 18% of the population, but now they're only 14% of households. Whereas before they were pretty much both the same, now they're quite short. So while there's been an 11% drop in the population aged 20 to 34, there's been a 30% drop in the number of households of people aged under 35. And we're short maybe 75 or 80,000 households headed by people under 35. And where are they? Are they looking to get out and purchase a home? Well, maybe some are, but the vast majority of people, if you go through your own experience, when we left home, we left into the private rental sector. And that's simply not possible now, given the constraints that are there. So when it comes to our housing market, there seems to be a lot of attention on home ownership. We seem to have first-time buyers, 17,500 on an annual basis who can purchase. Our home ownership rate, particularly for those who might be viewed as potential homeowners, the Irish and UK population, has fallen, but maybe not as simply as the headline rate would suggest. But look at a population of young people, and they seem to be stuck at home, and that is a significant problem, and maybe one that should be addressed. So if we move on, again, we can just begin to look at employment, and this is maybe a source of all this money. So we can go on to the next one and just highlight the increase in employment we've seen over the last 25 years, and just compare our position now, sort of in 2024, with about 2.8 million people working, to where we were at the peak of the previous boom, and like that was about 2.25 million. So we're about 500,000 people in employment higher now than we were in 2008. And again, like you go back to that time and you make a prediction like that, and it really wouldn't get any credibility at all. It took us until 2018 to get past get back to the previous peak. And maybe there was a view that we might stop there. COVID certainly tried, and you can see the volatility around 2020 and 2021. But once we came through COVID, it's been onward, ever upward since. And now we're hitting for 2.8 million people. Some of that has been driven by inward migration, the rise in the population, but we might expect that to be constrained by our housing issues. But if we move on to the next one, what we can see where a lot of the growth has been from the participation rate, getting people into the workforce. And now actually we exceed the participation rate we'd have had 15 years ago. And this is the entire population age 15 plus. Our population is aging. We have more over 65s, more over 70s, people we might traditionally associate not being in the labour force. So actually what we're seeing is back the ages in the 30s, 40s and 50s to offset the increased number of older people. There's more of those people getting back into the labour force. And we're now getting up to higher rates of participation in compared to EU countries. Traditionally, Ireland would have had low rates of participation compared to EU countries. They'd have had more people in the labour force. But we've seen that rise in recent years. And we're now not quite at the top. The Nordic countries would still be a bit higher, but we have been increasing in recent years. So it's driven by population, but it's also by the existing population, actually more people getting into the workforce that has just seen this extraordinary growth in employment and put us in a position that really is very, very strong. So if we move on to the next one, we can just look at sort of the transformation of Ireland over a period of time. So here we have just the percentage of the population that are working, like from 1970. And you can see for the 1970s and 1980s, we really were going nowhere at around 25%, and no indication that it was changing. Yes, there was people moving out of agriculture into non-agricultural employment, which was a positive, but in overall terms, employment was around 25%. But then from the mid-1990s on, the start of the proper Celtic Tiger, it surged up, got up near 50%. We weren't able to maintain it because we kind of reached the peak with a lot of borrowing. It fell and fell very significantly. But we've now got back up there again. And as I said, we're now back to close to the norms you'd expect for developed countries. So we've turned from being an underdeveloped country to being one that would be considered well developed in a very short period of time. And most countries started well before us. And when we did the catch up, first of all, we did the catch up very, very quickly, maybe a bit too quickly, couldn't sustain it, fell quite rapidly. But in recent years, we've risen, and not with the aid of borrowed money. As we say, we're now saving money. And it's remarkable that the economy has performed so strongly, even with all this money being set aside, and to get ourselves into a position where we're now up with, at least on an employment basis, some of the more well-developed countries of the world, is quite significant. So just to conclude, I think we have time to go through our last one. So we just move on. It's just where, from the government side, a lot of this money is coming from. And again, we just have to look at the US multinationals. I think we can use sort of a version of this pretty regularly, and you just keep having to update the numbers as they keep growing and growing and growing. So if you look at the contributions of US multinationals to the Irish economy, if we look at sort of the direct contributions, the pay to their employees, they have maybe approaching 200,000 direct employees in Ireland, paying close to 14 billion. That gets you an average of around 70,000 per employee, which is well above the average for the rest of the economy. If you look at their purchases of goods and services from Irish suppliers, whether it's things like logistics, distribution, catering, security, financial services, legal services from Irish suppliers, spending around 5 billion a year. Stuff they're building in the ground, data centers, pharmaceutical plants, another 5 billion a year. And now the one that we didn't target, but now the one we're certainly getting, the corporation tax that they pay. So we'd have traditionally been looked for the employment and looked for the investment, but because of changes internationally, we're now collecting the corporation tax, and maybe latest estimates, probably between 18 and 20 billion a year coming from US multinationals. And that gets us to a total of 44 billion. So if we look at where Irish households are getting the money, if we look at where the government is getting the money, really a key contribution is from the US multinationals. And while it's so successful, it does present a bit of a risk. And then just looking at corporation tax, we can move on maybe through the next two pretty quickly. So that's the total by year. Move on to the next one. That's just the total over the last 10 or 12 years, heading for 28 billion on an annual basis. So this doesn't exclude any Apple money. That 14 billion is additional to what we're seeing here, collecting on an annual basis 28 billion of corporation tax, and that's the latest data for 2024. So if we just move on to the last one, just looking at where US multinationals pay their tax. And this is data that goes back a bit. It takes a while for these numbers to be collated. And this is US multinationals, where they pay their tax. This is 2020. And note that the payments in Ireland probably have doubled since then. And this is the top 25 recipients of tax from US multinationals in the world. Unsurprisingly, the US is number one, collecting the most. They're US companies. They're going to pay most of their tax in the US. But if you look at where they pay their tax internationally, for 2020, Ireland was second highest outside the US. Only the UK were ahead of us. And given what's happened to corporation tax in Ireland since, we now know that we are second. The US is first, and Ireland is second. And if you take some of the other countries that are there and just the scale and the size of them, like you have China, India, in European terms, you have Germany and France, all much larger countries than us. And these payments are the total. Like if you do it in relative terms, these payments are much more important here. So we do certainly stand out. We are now the second highest recipient of corporate taxes from US multinationals in the world. And it's great to be getting the money, but certainly does present a risk. And I think we just should recognize where we are. So a lot of the excess that the government is generating is coming from corporation tax. Yes, it's the strong position of the economy. All of that employment is generating income tax and VAT. But if you just look at it on a pure money basis, that corporation tax is providing a very rich seam of tax revenue for the government. And it's right that the government should be in that surplus position because this is a particularly risky source of tax revenue, maybe as we'll get to in the Q&A. So then just to summarize the position we find ourselves in, so that's fine. We can just move to the end. We can just look at where we are in the main, like if we look at the household sector, putting very significant sums aside, and maybe we can look at the uses of that. In the housing sector, I think that the rental and the private rental is one that doesn't get much attention, maybe is where the most help is needed. From an employment basis, we are in a very, very strong position. We might have risks on the corporation tax side, but I don't see the significant risk feeding through into employment. And the government itself, yes, it has a risk from corporation tax, but at least we're in a reasonable position of running surpluses to be able to absorb some of the hits that might be coming down the track. So there's a run through of maybe where we find ourselves. I'm happy to take any questions that Neil might have collated from participants, and hope what you found there was useful.
Seamus, thanks very much. That's, like, as always, that is super interesting, and every year we have the same. We're all aghast at the corporation tax numbers, but we're not starting there. We're starting with the very obvious question that I think we're all asking ourselves this morning, which is around tariffs. So, like, the whole theme of this has been uncertainty and volatility, and we got a bit of that last night. The interesting thing about the announcements and his approach to his, I suppose, articulating his tariff strategy is he's trying to do it in a bit of an escalating way. Like, he started out talking about European VAT rules being discriminatory, which is an unusual position to take. Cars, pharma, which is a big point for us, reciprocal tariffs, and then he has this 25% announcement for the EU last night. So the two questions really here. One, is there much of a gap between the EU and the US to fill in the first place? Are these legitimate claims he's making? And two, it was interesting when you look back, in his first administration, he made lots of similar type claims that he didn't actually follow through on the tariff front. And the US multinational investment actually went up during that period in Ireland. So I'm not sure we'll be as lucky this time around, but interested to hear your view.
Yeah, you're certainly being topical, putting that up front. Give it, as you say, given the announcements last night. Like, is there much of a gap? Like, I think that the gap is primarily on the policy analysis side. Like, as you say, some of the claims that have been made in recent weeks seem bizarre. The idea that VAT is a subsidy or somehow subsidizing European enterprises competing with American enterprises seems a bizarre take to make. But that's what we're hearing. Like, the US has just retail sales taxes, whereas Europe has a VAT. In a sense, you could argue that because European companies face the VAT, they actually face a more level playing field, rather than dealing with US companies who might just face a retail tax in their home jurisdiction, because the retail tax isn't added at every stage, it's just added at the end. And then looking at sort of where we find ourselves at, like, what he's doing and what he's trying to claim. It really is quite difficult. Like, I think a key issue is what he says is just creating that uncertainty. And we're not really sure how it'll feed through and what the impact will be. But what's been said is certainly quite significant. And the different markets you're looking at, the different types, like from an Irish perspective, clearly pharmaceuticals play a role. They play a huge role in the corporation tax. They play a huge role in the employment, and they play a huge role in our exports to the US. We manufacture a lot of the active ingredients in some major pharmaceutical products. And with the announcements, it really is hard to know, will they be followed through on? So a couple of weeks ago, we had similar announcements of 25% tariffs for Canada and Mexico, and he rolled back on them within a couple of days. Now, he has been given a bit of grounding to this view of the EU in recent weeks, and now at their first cabinet meeting yesterday would have come out and said they're going to do it. It remains to be seen. Like, he kind of sells himself up as being a sort of negotiator, so it's hard to know if he's going for something else, but it certainly would be significant. And from an Irish context, I don't think the impact would be immediate, particularly not on the employment front. Like, these companies have multi-billion euro investments in Ireland. They're not going to up sticks because there's a tariff imposed, at least not in the medium term. Like, these factories have a life cycle and they'll see through that. But we might see changes in terms of structures, intellectual property, the pricing, the corporation tax. And that's probably where more of the risk is, but not necessarily on the employment side. But really, the big one is the uncertainty. If you're in a US boardroom and looking at making decisions, one thing you're trying to reduce is uncertainty. And maybe just putting more of your manufacturing facilities in the US is one way to overcome that.
We're certainly not going to build a pharma plant here in the short term. I'm very conscious of time and people's time at home. Housing, I suppose we need to, you talked about young people being stuck at home and an aging population. There's been a lot of chat about bringing private investment back into this market, and it's probably fair to say the government are looking at replacing this rent pressure zone system, which is probably very highly regulated compared to other jurisdictions, which like high income jurisdictions elsewhere have a very market approach to that. Few of your fellow economists talk about moving to a reference rate system, but that probably there's an issue with that because there's a supply issue that doesn't address. Do you have a view on the best approach to attracting private investment in this space?
I suppose stop scaring it away would be one of, like we mentioned, like the changing composition of housing there, and we're seeing more first-time buyers purchasing new housing. Like our housing output kind of stalled a bit last year. Like there was suggestion that it would be close to 40,000. It never really pointed in that direction, ended up being around 30,000. But what was most significant within that was the decline in output of apartments to be replaced by scheme houses. So we did have some investment coming in to provide rental accommodation, building apartments. But actually we're seeing that fall, and we're likely to continue to see that fall in 2025. And that would be, a big concern, particularly where I think the pressures are most severe in the rental sector. Like if you look at listings online, you can find listings for houses to buy. Yes, because of demand, prices are rising, but at least there's something available. You want to find somewhere to rent. And like really, you can imagine any property being listed getting hundreds of inquiries almost immediately, such as the pressure there. And like we have a housing system with three elements. Like there's the private ownership element, there's a social housing element, and there's a private rental sector. And they are all legitimate forms of tenure. And everybody in each of those sectors is entitled to housing. But we seem to be squeezing one out, and the one we're squeezing out is the private rental sector. And the consequences of that are pretty significant. How can we get investment back in? Well, I think one thing to do would be just to stop. Like we keep changing the rules and the regulations and the guidelines, whether it's on the construction, the planning, the rent setting, just talk about the level of uncertainty being generated by all these changing must be significant. We talk about Trump providing uncertainty for US multinationals. Like imagine trying to invest in housing in Ireland and facing the regulatory environment that seems to change very, very quickly. Are we going to move away from the rent pressure zones? Like there isn't much economists agree on. We're generally be known for our disagreement and various things. But when it comes to price controls and rent controls, there's almost universal agreement that they don't work. They work for some people. If you're in a property now and you benefit from rent controls, that's actually absolutely you winning. But rent controls then have a big impact on supply and on the unseen. So in Ireland, we love a good insider outsider problem. So we will, like when there was huge numbers of delinquencies and mortgages, we didn't have repossessions when people weren't repaying their loans. We protected those on the inside. Now in the private rental sector, if you have a property, you can benefit from these rent pressure zone rules, which limit your rent increases. And you were quite happy with that. But on the other hand, if you were trying to buy a house and you're looking at somebody not paying their mortgage staying there, or you're trying to rent a house and it's simply not available, you're on the outside, you will get very little support in the Irish policy sphere. And it is quite a difficulty. I think housing is a significant issue for Ireland. I don't really see us addressing it effectively over the coming years, particularly with the nature of policy as it continues to chop and change, and that sort of narrative opposing those who might come here to provide housing, which is what we need. So I think one thing to do would just be to stop and maybe to get a better emphasis of where the problems are most acute. They're most acute in the private rental sector. And for a period of time, that is the appropriate or preferred tenancy status for people. Yes, they want to move and purchase a home, but the key thing to get people out of home in the first place is to get them somewhere to rent. And we haven't got that now.
And your piece on deposits was very interesting. The scale of the deposits that are in the banking system that are earning little or nothing is incredible. You just talked about housing there, and I noticed that there was a scheme in France where I know there was a UK one a while back, the ISA, but the one in France, you can save up to a certain amount. You've got income tax relief, you've got CGT relief. The bank can take 40% and go off and invest that in sustainable social and affordable housing, essentially. Would you be in favour of a similar type scheme here to put the deposit money to better use?
Yeah, I think any sort of imaginative approach can be considered, particularly when it comes to the finance. If we're after driving the international financing out of the market, as it seems we are, we'll probably have to provide much of it ourselves. And maybe at the lower level, we're not seeing the small builders get involved in housing construction. If you drive around our towns and cities now, you see all the small builders involved in retrofitting. You can just see the scaffolding going up everywhere. They're not out in fields building the 10, 12 houses they might have been doing 15 years ago. And that presents an issue from the employment perspective. Where do we have the workers? But where do we find the financing? And clearly, like, the banks have huge amounts of money on deposit, and the banks are quite happy with it, because they in turn, they're not paying any interest to the Irish households giving them the money, but they're putting it on deposit with the central bank. And they're getting what? They're getting about 3% now. Like, the banks keep announcing very large profits. In the main, they're getting that profit from doing nothing. So it would be actually much better for us if we had that money doing something. And maybe Irish people have a tendency and a likeness to invest in property. Historically, we'd have done it directly. People would have bought 1 or 2 houses, the small landlord, but maybe that's falling now. So maybe we could set up a scheme where actually you could say, look, you have these savings, we want to put it into the housing sector on a very stable basis. Like, the issue with social housing is that the rents are almost guaranteed by the state. And we see happening through the approved housing bodies. They're all in a reasonably strong position. Many are expanding. No, there are governance issues clearly with a couple of them, but most of them are in a strong position. So yes, for Irish households with pretty significant sums, some who might have a predilection for putting money into property, we don't seem to buy shares or exchange traded funds, all of which are becoming more readily available. Maybe we could access some of that funds and direct it towards housing, and that would be a positive move to make if some of those schemes you've mentioned internationally could be replicated.
Okay, and these issues are all tied together. The last thing I want to mention to you is just around the infrastructure deficit we have here. And we have to build housing at scale. We have to build a metro link. There are huge, I suppose, inflationary type risks that come with like our track record in infrastructure projects wouldn't be brilliant. And my question really there is, like, do you have a view on one of the things that comes up quite regularly in conversations about how do you broaden the tax base to help with this?
Yeah, so clearly on the infrastructure side, we do have deficits. Now, in part, it's because of success. The population has been growing. Like the needs of the population are greater. As you say, we do have certain failures, but we must admit, like, we do get some things right on occasion. And maybe one comparison we make between ourselves and the UK is on runways. And we pretty recently would have had Dublin Airport expanded with a second runway at a modest cost. It was long-term planning, land was sterilised. I think the total cost was somewhere around 350 million. And if you look at what they're doing over in the UK, trying to add an additional runway to Heathrow, they've been struggling for decades in terms of whether they're going ahead, they're not going ahead. The cost is in the tens of billions because they have to buy a small town. So from a runway perspective, we seem to be doing okay. But then you could look at hospitals and say, well, we're not doing so successful there. So we certainly can do better. Like, when it comes to the government, money isn't the issue. We like, as long as the corporation tax is there and some of it is set aside, which the government are doing, you can have a fund that you can draw down in recent years. Yes, we can look at broadening the tax base to reduce some of those risks. When it comes to doing these infrastructure projects at the moment, it's not really an issue of financing. We do have the funding available. It is really an issue of the real delivery. Can you get through the planning system? Can you get the site? Can you get the staff? Can you get the costings done? Can you get the actual thing produced? Like, we put tens of thousands of workers into retrofitting housing, and we've incentivized that with very significant subsidies. Is that the best use for our scarce construction workers? And you could argue that no, it's not. That actually our priority should be building new houses and adding to our infrastructure. And then maybe in time we can go back and retrofit our existing housing stock. But the political system doesn't want to talk about things being a priority, but everything is a priority. And if everything is a priority, nothing is. So we want to do everything, but we simply can't do it. We have the money to do it, but we just don't have the resources. When it comes to infrastructure, I think we just have to prioritize what we're doing. Yes, we have some bad examples, but hopefully we can replicate the runways rather than the children's hospitals.
Should we put more money aside from the corporation tax surpluses? I think there's about a third gets put aside. And I know that you have a view on, like, government spending every year, that there's a, they come out and say we're going to spend 5% this year, and they always maybe double that. This is close to the bone with your current job, I know, but like, do you have a view on just a little bit more fiscal management there?
Yeah, so like the government finds themselves in the position where the resources are available, and like maybe in those circumstances it is harder to have that sort of more, I suppose, disciplined approach. And when you look at, we have problems, like we have problems in housing, health, etc., and you say you have money to address that you can use to address them. Throwing the money is the easy solution, but does it actually deliver real improvement? Like, you can put more money into the health service, but unless you get more services produced, Are you seeing any real improvement? It's like, who is going to provide them? How are we going to get the workers in? How are we going to build more housing? And like when it comes to the overall position of the public finances, they are in a good position. They are running a surplus. Well, that surplus is entirely dependent on those corporation tax receipts, and things like the Trump tariffs could have an impact on those if companies change their structure, particularly when we're such a kind of high profile out there. The second largest recipient of corporate tax from US multinationals in the world, that puts you front and center. So you would look at maybe balancing that. But when it comes to actually doing things, I don't think money is our key problem, at least now. It's actually making the priority to say, this is what we want to do. Do we want to reduce building data centers or pharmaceutical plants, retrofitting housing because we want to build new houses? Well, our political system finds it hard to make those choices. They'll say the words, oh, housing is a priority. But if you drive around and see scaffolding going up on every 10th or 20th house in suburbs, you can see where the workers are.
Well, let's see what the audience think. I don't know if the poll results are available there to look at. So the first question was, what was the single biggest threat to the Irish economy in the next 12 months? And yeah, naturally enough, 59% say increased tariffs, 31% say housing. I think that's consistent. I think we all know the view on that one, Seamus. We won't go over all ground on that one, but maybe if you look at the second one here about the government's primary focus in tackling housing crisis, very interesting to me that there's a big spread there, because the actual, probably from my perspective, the correct view on this is all of the above. So I don't know if you have a particular view on that. Yeah,
like I think you'd just like to see a bit of kind of stepping down of sort of the regulations that are kind of impinging on the development. Like you look at making it more attractive from a financial perspective, but I think it's the non-fiscal, the non-tax elements are the key ones, like when it comes to planning regulations and just our general approach. And I think even on the tax side, you can look at the private rental sector. Like we've said to people, don't come here with your money and buy properties to rent out. And to people who want to rent, like we've put a huge stamp duty on those who might buy multiple housing to rent out. Like, why are we saying that we don't want housing provided for people that will rent? Like it seems a bizarre take to me. Oh, housing must go to those that own it. Like, why aren't renters entitled to somewhere to live as well?
Yeah. The last one there, which is a nod to my tech and financial regulation colleagues, is what's the biggest concern in financial services digitalisation? Interesting that 69% of respondents said cybersecurity threats. Yeah, I think that's something that is an absolute record for businesses, and probably the uncertainty that comes with European regulation in that space, and how the EU is ramping up can create a bit of uncertainty in that space as well. So given that we've mentioned uncertainty about 100 times in this session, it's probably apt that we finish up with that theme.